Morning students, welcome back to the session on audit. So today we'll start with another auditing standard that is in respect of the series related to this audit reporting that we have been discussing. So it's about SA 706, and in respect of SA 706, generally it is understood as if the matters which are going to be reported as per the requirements of this auditing standard are qualifications or the modifications, but those are not really the modifications, but those are you can say some sort of matters which are reported by the auditor in the auditor's report, even though they don't happen to be the one which are qualified or maybe reported like an adverse opinion in the auditor's report. And we'll try to understand the perspective around these matters. In respect of these matters, that is about emphasis of matter and the other matters, as we discussed that these are not really the modifications. So that means modifications are only the one which we discussed in the last session. It can either be the qualification, or it can be the adverse opinion, or can be the worst form wherein the auditor is unable to express an opinion, which is in the form of disclaimer of opinion. So let us now move on to understand what are the requirements of this auditing standard and what all do we mean by this emphasis of matter and other matters which is reported in the auditor's report. And then we'll also look at certain audit reports to understand how these will get reported in terms of the language, etc. Emphasis of matter. So what do we mean by emphasis of matter? It is basically about including a para in the auditor's report in the form of emphasis of matter. So let's understand what do we mean by this emphasis of matter paragraph. A para which is included in the auditor's report that refers to a matter appropriately presented or disclosed in the financial statements that in the auditor's judgment is of such importance that it is fundamental to users' understanding of the financial statements. So this is about emphasis of matter para definition. Let's also understand the meaning of other matter paragraph, and then we'll get into the details of all of them. Other matter paragraph. A paragraph which is included in the auditor's report that refers to a matter other than those presented or disclosed in the financial statements. Now, this is also a difference. If you compare this with emphasis of matter paragraph, it says other than those presented or disclosed in the financial statements that in the auditor's judgment is relevant to users' understanding of the audit, the auditor's responsibility, or the auditor's report. Okay. So this is about both of these requirements in terms of their meaning. Now we'll get into more details as around both of these requirements, and we'll try to understand the perspective which is involved over here. So moving further on to emphasis of matter. Let's understand the requirements. If the auditor considers it necessary to draw users' attention to a matter presented or disclosed in the financial statements that in the auditor's judgment is of such importance that it is fundamental to users' understanding of the financial statements that the auditor shall include, in such a case, auditor shall include emphasis of matter paragraph in the auditor's report, provided. Now, what is this provided? So this is subject to certain points, and these are very, very important points. Provided A, the auditor would not be required to modify the opinion in accordance with SA 705. as a result of this matter. And when SA 701 applies, SA 701 is for CAM. The matter has not been determined to be a key audit matter to be communicated in the auditor's report. Because if that matter has been considered to be a CAM, that should not really be considered as emphasis of matter. Because if a matter has been considered as emphasis of matter, that should not really be considered as CAM. Moving further, it says when the auditor includes an emphasis of matter paragraph in his report, the auditor shall include the para with a separate section of the auditor's report with an appropriate heading. You remember the heads and the subheads we discussed? Opinion, basis for qualified opinion. Now, instead of opinion, after the opinion, the auditor will also be including a term emphasis of matter. So there will be a separate section in the auditor's report. Secondly, the auditor shall include in the paragraph a clear reference to the matter being emphasized and to where relevant disclosures that fully describe the matter can be found in the financial statements. The paragraph shall refer only to the information presented or disclosed in the financial statements and indicate that the auditor's report is not modified in respect of the matter emphasized. All right. Now let's try to understand this requirement with the help of an example, and then we'll also understand as to how this is really presented in the auditor's report. So we are talking about two types of reportings. First is about emphasis of matter. Now let's suppose this is the auditor's report. And these are the financial statements. Okay, so it comprises of balance sheet, P&L, etc., notes to accounts, all of this stuff. And then we have the auditor's report. Now, in the auditor's report, auditor wants to report a matter, but at the same time, auditor is very clear that there is no material misstatement in the financial statements. There is no material misstatement in the financial statements. So that's why modification cannot come. But auditor still wants to highlight a particular matter. So let's suppose a matter has been reported in the notes. In the notes to accounts, a matter has been highlighted. Say if we look at the notes to accounts, it's note number 27. A particular matter has been explained. So the management has given that matter, reported that matter quite comprehensively. In detail, they have explained all the requirements of that matter. But this matter is something which is very important for the understanding of the users. In terms of users to understand about these financial statements, it's very important that the users really focus on that requirement. If they don't really focus on that, then it may be leading to not a very clear understanding of the financial statements on their part. And that's why auditor considers his responsibility to focus on that, to highlight that matter, to bring this matter to the attention of the users. Because if you look at this complete set of financial statements, there's so many things involved in this. There's a balance sheet, there's P&L, cash flow, then notes, and in fact, in terms of notes, there's so many disclosures. It's not limited to one. There could be so many disclosures. These financial statements may be, let's suppose, they're running into 70 to 80 pages. So will the user be really be able to get into that matter? If he reads the financial statements carefully, he can understand that. But if we need to highlight this, or if we highlight some matter, what will happen? It will come to his attention. So it is also as if, let's suppose you prepare your notes. When you are preparing your notes, there are certain matters which you will consider as complex. Complex because these became difficult for you, or really are required to be focused upon by you, or you consider them important from the examination perspective. So what do? You will mark those matters as important, or maybe you will write that in a different ink, or maybe you just keep it separate. Okay, something you will do so that it gets highlighted, because your notes will again be running into hundreds of pages. So to bring out all of those points, to highlight all of those points which you can just really focus on, what will you do? You will mark those. So same is the case over here, because financial statements are again bulky. They contain a lot of points. That's why there is something which the auditor needs to do so that he can bring this particular matter to the attention of the users. And this is done by bringing out emphasis of matter, EOM. So in the emphasis of matter, what will the auditor do? He will highlight this. He will say that during the course of the audit of the financial statements, such a matter has been looked at by him. Yeah. And that matter will be briefly covered by the auditor over here. That is briefly covered. Auditor will not write too much details around it. Okay, because that's not really the intent. He just wants to bring it to the notice of the users that there is a matter on which they need to focus on. So he will only briefly cover this matter. Secondly, he will draw the reference of this note. He will give the reference of note number 27. Why? Because if he has briefly covered this matter, which the users need to know, so he is giving the reference that in case you want to get into this matter in more detail, so what can you do? You can just very simply go to the financial statements, refer this note, wherein this matter is covered in detail. So it's a detailed disclosure. So if the user will need to understand this matter, they can just go to the financial statements and read this over here. Okay. But now the user may also get confused. Why? Because user is expecting the auditor's report to give his opinion. In the opinion, everything came out very nicely, except for this para, wherein user is trying to understand about this matter and about the way it's been covered. And user may get confused that if the auditor is highlighting on this matter, then there seems to be some problem. Some problem in the financial statements, only because of which auditor would have highlighted this. So now, to clarify him that everything is fairly stated in the financial statements, the financial statements are not materially misstated. even though this matter is highlighted, everything is still okay. So what will the auditor do? He will specify that there is no modification in his auditor's report. He will specify that there is no modification in his auditor's report. Everything is all okay. By doing this, he has highlighted at the same time clarified that everything remains okay in his auditor's report. Clear? Now, what we will do is we will look at one report and we'll just try to understand as to how this is actually presented, or the way what we have discussed over here, how this is actually covered, and then we'll also try to understand some of the matters could be the one which need to be highlighted in the financial statements, but at the same time they should not be qualified. There should not be any modification in respect of those matters. So what could those matters be? So I think we can go to one audit report for this. Just 1 minute. Okay, so let's look at this report now. It's the report of a company on consolidated financial statements. Okay, so basically on the financial statements. And let's read the opinion first of all, because we understand that opinion is the first thing which any user will look at. So maybe you can just quickly read the opinion. So if we read the opinion, we find the second para. If you read the second para under the opinion, let's try to understand whether it is qualified. It doesn't seem to be qualified. One, because of the fact that if there would be a modification, if there would have been a modification, the header would have been changed, correct? Or the subhead would have been changed, but it's not changed. But anyways, maybe there could be some problem in the subheading. So let's read the para also. It says, in our opinion and to the best of our information and according to the explanations given on us and based on the considerations of reports of other auditors on separate financial statements of joint ventures referred to in other matters section below, the aforesaid consolidated financial statements give the information required by the Companies Act in the manner so required and give a true and fair view in conformity with Ind AS, which are prescribed under the Companies Act, so and so, so and so. Yeah, so that means opinion is absolutely clean. Yeah, opinion is all okay. So if we go below, we see the basis of opinion is given, and the basis of opinion will again be for clean opinion. Yeah, but after the basis of opinion, what do we see? We see there is an emphasis of matter. Something like this has been reported by the auditor in his report. And let's try to read the language of this and let's try to understand this matter. So what is this matter? It says we draw attention to, so that means he's trying to highlight, bring it to the knowledge, wants the user to focus on this matter. He's saying we draw attention to note number 24 of the financial statements, which describes the uncertainties related to the outcome of Department of Telecommunications demand with respect to one-time spectrum charges. If you read this para about the emphasis of matter, do you really think you will be able to, or do you think you have been able to understand about this matter? No, I don't think so. Though briefly I can understand the nature of this matter. It appears to be a matter with regard to some spectrum charges or one-time spectrum charges for which there must be a demand which has been made to the company. So it appears to be a litigation related matter. But we don't have any clarity around this matter, number one. If we just read this para. Yeah. But if we read this emphasis of matter paragraph further, it says our opinion is not modified in respect of this matter. Now, auditor is clarifying over here. Auditor is saying, even though I am trying to highlight this matter, still don't think that there is any modification. There is no modification. Okay. So what has the auditor tried to do? He has only touched upon this matter briefly. Or you can say he has just given reference of this matter. Yeah. He has also referred the note. Now, if I am very curious to understand about it, or if I really want to focus on this matter, if I really think there's a need to read this, what will I do? I will go to this note or this note which is referred in the auditor's report and read that matter. And I am also clear about this matter that there is no modification. Correct? Yeah. So what we can now do is we can also go to this note and we just try to see whether it's been detailed out over there or not. Yeah. So I'll just quickly move on to this note number 24 IFC. So let me just try to find out this note. It's note number 24 IF6. Okay, so this seems to be the matter. Note number 24 IF6. 6. Okay. Now, if we look at this matter, it appears to be quite detailed out. Now, once again, we don't need to get into the technicality of this matter. That's not really the requirement for us right now. Yeah. And even if you want to get into the technicality, you can just pick up any of the annual reports or the financial statements and you can just go through a lot of those matters. What we wanted to understand over here was that how is this emphasis of matter given and what is the nature of this type of reporting by the auditors in their auditors report. Okay. Yeah. And I'm just hoping that all of you are now clear on this. All right. So now I'll come back. I'll come back to our discussion on this matter because we have seen as to how this is really highlighted. Harshad has a query. Harshad is saying, sir, we will highlight those important matters to emphasize on it. Yes, of course. And this is how it's been done. Okay. Now we need to understand what all matters are required to be reported like this. One point which we have understood is okay, that how these matters are required to be reported, but which all points are required to be covered here, or what's the criteria for assessment of emphasis of matter. Okay. So let's understand about the criterion. For this, I'll have to take you back to the presentation. So what was the requirement? Let's read this para number 8 once again. The auditor, if he considers necessary to draw attention to a matter which is presented or disclosed in the financial statements. Now, this is very, very important. Matter which is presented or disclosed in the financial statements, that in his judgment is of such importance that it's fundamental to understanding of the users. So I'll just note down some of these points. So for EOM, one is matter is covered in financial statements based on the judgment of the auditor. Based on auditor's judgment. Number 3, fundamental to users' understanding of the financial statements that auditor shall include EOM. Fundamental to users' understanding. Okay, so these are the points which can draw and which we can now focus on. First point. It appears from the first point that if there is any matter which has not been covered in the financial statements, then the EOM cannot come, and which is absolutely true. For the EOM to be reported in the auditor's report, it's a must that such matter should be somewhere reported in the financial statement, should be covered somewhere in the financial statements, and for which the reference can be given in the auditor's report. Because EOM cannot be there in respect of any matter which is not covered in the financial statements, and to which reference cannot be drawn in the financial statements. Okay, so it's a must. Number 2 is that it should be fundamental to users' understanding, even though it's not getting qualified. Even though it's not getting modified. So that means the matter should be such which is not leading to any material misstatement in the financial statements, but that is of very, very importance to the users of the financial statements. Now, what can be such matter? Generally, if you will see, if there are litigations, generally, if you look at the litigations in respect of a company, what will happen? If we look at the case which we looked in this auditor's report of the company, it was about some spectrum charges demand. Means any regulatory authority must have demanded some money. Okay, it seems to be a statutory demand, which may not really be agreed by the company, because the company may not agree with the amount which is demanded or may not agree with this demand at all. So it's not really necessary that the amount may be disputed. It may be that principally this demand may be disputed. Say for example, a company has received a demand from income tax and this demand, let's suppose, is for rupees 59 crores. Now, either the company may say that the demand should not be 59 crore, it should be 9 crore. Means either the amount could be disputed or the company may dispute this entire amount. Means principally they may think that the grounds of these demand are not correct and they may dispute this. And this is again possible, because it's up to the company, it's up to the entity. If they want to dispute it, they can dispute it. There have to be valid reasons for this, and there are lakhs of litigations which have been going on. But in respect of such matters, first of all, accounting will have to be evaluated, and then their reporting implications will have to be assessed by the auditor. So let's understand the accounting requirements in respect of this matter, and then we'll get on to the auditor's reporting. Let's suppose there's a demand of 59 crore on the company. Now, what would the management do? Management would get this evaluated through its experts, through its tax experts. Now, this tax expert could be in-house or it could be outside the company, means it could be external to the company. And what would those tax experts really do? They would comment on the basis of the matter which is involved. What's the likely outcome? Because the matter is not under litigation as of now, the tax experts will assess the likely outcome of litigation which the company may want to get into. Company may want to dispute this amount. So the tax expert will comment that if the company disputes it, what are the chances that the company will win that litigation, and what are the chances that the company will lose that litigation? Okay. Now there could be certain scenarios wherein the tax experts on the company conclude no, they will not lose the case. So that means they will win the case. In such a case, what will they do? They will not create a provision for this, because now the question arises because a demand has been imposed. That's why a provision in respect of this amount should be created in the financial statements. But the company is saying there's a strong chance that if it is disputed, the company will win. So that's why they will not create a provision for this. Correct? Number one. Number two. Sorry, on this likely outcome, therefore, we can say, so company is saying they will win. So they will not do anything in the financial statements. Let's suppose company gets a view that most likely they will lose this case if they get into a dispute. The chances of winning are not there, so they will not win the case. So in this case, what will the company do? They will create a provision. They will create a provision. Yeah, even if they plan to get into the litigation, they will create a provision. This is the second possibility. Another possibility is that of no clarity, or we can say company is not sure. No clarity means not sure. So the matter is such that today, when we are into a litigation or when we are planning to get into a litigation, it cannot be said with clarity whether the company will win or lose the case. It's 50-50. Company is not really sure about it. And the tax experts, all of the teams which have got into the evaluation, they are not very sure about it. So therein, what will the company do? Company will create a contingent liability. Correct. Now, in respect of contingent liability, there is no clarity. It's a case of 50-50. And if you look at this contingent liability, it is something which is more of in the nature of an estimate. It's very, very judgmental. And because of this lack of clarity, because of this accuracy which is missing in respect of this matter, can the management and the auditor really evaluate whether it should really be a contingent liability or a provision? No. But still, on the basis of their best judgment, what did they decide? They decided to keep it as contingent liability and not to create a provision in respect of this matter in the financial statements. Because if they create a provision, what will happen? There will be a charge of 59 crore in the financial statements. Now let's look at the size of the company. If we look at the revenues of the company, these are around, say, 1800 crore. And the profits are, let's suppose, around 89 crore. So company has a profit somewhere within this range. Now let's think of a situation wherein this charge is required to be created in the financial statements. The moment we create a charge, this profit of 89 will come down to 30 crore. And in certain situations, it may also be possible that the profit is, let's suppose, around 50 crore. In such a case, what will happen? The profits of the company will be wiped out. Many a times, the demands are running into hundreds of crores, wherein because of this demand, the company may be wiped out. If this is actually sort of levied and the company loses the case, the very existence of the company may get challenged in such a scenario. Such could be the importance or such could be the relevance of these matters. Okay, yeah. Now, if we look at this matter, we will understand that a position has been taken by the management in respect of this matter the way it has been recorded in the financial statements. And that position has also been accepted by the auditor. So auditor is not disagreeing with the view of the management. No, it is not disagreeing. Auditor agrees to the view of the management. But at the same time, both of them know that it's a very critical matter. And it is very, very important for the financial statements, for the company's operations. And if this judgment, which has been taken by both of them, goes wrong, it could impact the financial statements the way they have been currently presented, measured, and the way the disclosures have come out in the financial statements, that they may change significantly. So that means they are very fundamental to the financial statements. The very basis of the financial statements will get changed if the likely outcome changes or if the judgment goes wrong. And once again, if we talk about this judgment, it's more about the estimates. There's no accuracy. So it cannot be said with accuracy today that tomorrow company will only win. They may eventually lose. And that can be a big hit on the financial statements, the way those have been presented today. They may change significantly, let's suppose 2 years later. Now, in such a case, auditor feels that there is a need to inform the users, the stakeholders about any such matter. Why? Because auditor knows it's a judgment which has been taken not only by the management but also by the auditor. So that's why it's very important on the part of the auditor to bring it to the knowledge of the users of the financial statements. Clear? Clear about this? Yeah. Another situation which will generally form within the purview of emphasis of matter. So this is one. Another situation which will generally fall within this purview. That is about going concern. So let's try to understand that again with the help of an example. In respect of going concern, if you remember, we discussed about this matter in great detail. Yeah. And along with going concern, we also discussed about some sort of material uncertainties. Correct? And for the material uncertainties which are not really impacting the going concern, we also understood that there's a specific reporting requirement in the auditor's report. Even though it's not a qualification, specific requirement is there in the auditor's report. There's a separate section for the auditor to report on such a point. Now, in the light of all of those requirements, there could also be a situation which may lead to emphasis of matter. Many a times, there could be certain material uncertainties. Yeah. How would those material uncertainties be addressed? When the auditor would really get into those requirements in relation to assessment of the liquidity of the company, in relation to the cash flows which are required on the part of the company. Yeah. Many a times, this evaluation of going concern may require significant working on the part of the auditor. Because the going concern of the company is not really a problem if we look at the financial statements today. Say, if we are looking at the financial statements of the company for 2020-21, auditor has concluded on the basis of the assessment made by the management that the going concern assumption is okay. But definitely there are certain problems within the company, because of which this going concern could be a problem in future. Yes or no? Yeah. Now, because this could be a problem in the future, so that's why it's very important for the auditor to not only evaluate and conclude, but also to get into the reporting of such matters. And in respect of reporting of such matters, it's absolutely clear that if the management gives the disclosures in the financial statements, then it is fine. But if the management doesn't give the required disclosures in the financial statements, then what will happen? Instead of just highlighting all of these matters, or instead of just reporting all of these matters the way those are required to be reported over here, it may also lead to a modification. Okay, clear? Now I'll move on to some of your queries. Naga Sai is asking, if disclosure of CAM and EUM be the same, is disclosure of CAM and EUM same? Could you please give me an example for us to differentiate between EUM and CAM? I'll come to this. Harshad has another query. Harshad is saying, sir, can a negative net worth be an EUM, or sometimes negative cash flows appearing in the books so that it can be an EUM? So this was absolutely the situation which I discussed with you. If you look at the negative net worth of the company, this could be an indicator for EUM. So this definitely is an indicator for going concern issue to be evaluated, but this could definitely trigger some of the reporting requirements in relation to material uncertainties or EUM for that matter. And same is the case for negative cash flows. Okay. Harshad is saying, a matter of emphasis may not be so important for users as it depends on the auditor's judgment whether a matter is to be classified as EUM. See, if there is any matter which is important for the users or not important for the users, its evaluation in terms of its reporting as EUM has to be made by the auditor. It's completely dependent on the judgment of the auditor. But at the same time, let's also try to understand about this term judgment. Okay, because we have used this term quite a lot. Judgment. We keep talking about judgment. Let's try to understand about the judgment also. So what do we mean by auditor's judgment? It has nothing to do with the standard, because this is something which will apply to everything related to the audit. Judgment. What would be the factor on the basis of which judgment will be made by the auditor? And how will this judgment really come? For judgment to be applied, auditor should have knowledge, skill set. Correct? Let's suppose a matter is required to be evaluated as per SA 706. And let's suppose auditor has not read this auditing standard and he applies his judgment. So can we say that he has applied his judgment? No, because for judgment to be applied, there has to be a knowledge. If the knowledge is not there, can he apply the correct judgment? Not at all. Let's suppose a matter has to be evaluated as per Ind AS. Yeah, the management has got the accounting done through their team, but this matter, the way it has been presented or recognized in the financial statements. Who will evaluate this? Auditor. And for this, he would need the knowledge of accounting. But he doesn't know about accounting standard. He has not read the accounting standard. Or maybe he is not very clear about some of the requirements of the accounting standard. So will he be able to do this? No. Let's suppose there is a litigation. It's a legal matter. Related to telecom industry. So there is a dispute which has impacted every player in the telecom industry. Auditor doesn't have the knowledge of this industry at all. Will he then be able to evaluate this matter? Not at all. Not possible. He will not be able to do this. Why? Because for him to evaluate this, for him to get into this, what does he need? He needs the industry knowledge. He needs the knowledge of this matter. Yeah. So that means if the auditor has to apply his judgment, he needs to have the knowledge, he needs to have the experience, he needs to have the skill set. Say for example, it's a legal matter and let's suppose there are many companies in the telecom sector. Say company A, company B, company C, company D. Now, if this matter has arisen, would this matter only impact company A? No. This matter would impact each and every company. And that's why it's not only company A which would have reported or recorded this matter in its financial statements. Every company would have done this. That's why it's very important for the auditor to look at the industry practices, accounting practices, to form his judgment. Let's suppose all these companies have taken a position which is not in line with company A. Company A takes a different position. Or let's suppose company A also takes the position which all of these companies have taken. But the auditor doesn't agree with the position of A. Why? Because he doesn't have the knowledge. So will that be considered to be the correct judgment? No. Not at all. So that's why when it comes to the meaning of judgment, it all depends on the experiences, the knowledge, the skill set. And that should form the basis of the judgment. It cannot be the whims and fancies of the auditor. It's not like that auditor has uttered something and that will become his judgment. No. He has to be very, very careful. Yeah. It cannot be without the application of all of these things that he will take a judgment. Because let's suppose if he has taken a position which is not really in line with what all others have been doing, or which is not in line with what has been done in the past, can this judgment be considered to be all right? Not at all. So he cannot just say that this was my judgment and this can be different from others. It is possible. There could be certain scenarios wherein the judgment may be different on the part of various individuals. But then a question arises, that was this judgment really based on a matter wherein the facts were different? Because if the facts have remained all same, then why are the different individuals taking the different positions? If we have the knowledge and the skill set available, or if we have the guidances available. Yeah. So for these two, we have the guidances. There's a lot of guidance available. Now the guidances are available on auditing standard, guidances are available on Ind AS, guidances are available on a lot of legal provisions. And this would only increase the knowledge. Why? Because this will give insights about the past practices and the positions. Correct? Clear on this? So that's why when it comes to the judgment, there is no doubt judgment has to be applied. That has to be based on all of these factors. Okay. Then I think there's another query from Harshad. Harshad is saying a matter of okay, sorry, this one is done. Then Naga is asking, what's the difference between this disclosure and CAM? See, CAM is something which is not about highlighting the matter in the auditor's report. And let's take one example to differentiate between these two, though my idea was to really come on to this matter later on, but we can touch upon this point even now. Say, for example, if we look at inventory valuation, okay, and this would be a very good example to discuss about this difference. The valuation of inventory is very much mechanical. It's very much mechanical. And for companies, these are generally system driven. Companies are now onto ERP packages through which inventory valuation is done. Yeah. Most of the companies, if you look at, they are doing their inventory valuation through systems, through ERPs. And even if some of the valuation, or even if a part of the valuation is done, some part will be through systems. So we can say some part is manual and some part is system driven. Okay. Now, in respect of inventory valuation, there is no material misstatement for a company. Okay. So now we are looking at a situation that there was no material misstatement. So auditor has audited and did not find any misstatement. At the same time, there was no matter which we can say involved judgment on the part of the auditor. It's not judgment. Okay. So there is no subjectivity. So when we say judgment, there was no subjectivity which was involved in respect to this matter. It was all mechanical exercise. Because this was very mechanical and because it was also full of manual interventions, that's why there was a chance of making the mistakes. Okay. Chances of errors were significant, and that's why auditor was required to spend significant efforts on this. That's why significant efforts on the part of the auditor were involved. Means the time of the auditor spent on this was quite significant. Correct? And this also became a very risky area. So this was really a matter of significant risk. Okay. Now let's try to evaluate this matter from the perspective of EUM. All of you, and you can also share your thoughts on this point. Nagasai, you can also do this. On the basis of the understanding about EUM that we have obtained, can we say that this matter will become an emphasis of matter? Quickly, over to you. Can we say that this matter will qualify to be reported as CAM, as EUM in the auditor's report? Can we really say that? Will this matter be reported as EUM? Do you think it will be right to say that? To report this matter as EUM? The answer is no. Why? Because what's the need to highlight this matter? Say if the inventory has been valued, it's reported in the financial, it's measured in the financial statements, it's reported over there. What will the auditor do by focusing on inventory? There's nothing. Is there anything in respect of inventory in terms of its outcome which can really impact the decision of the users by going through the financial statements? No. Is there any misstatement? No. Is there any outcome of this reporting of the inventory in the financial statements which the user needs to analyze? Not at all. Everything in respect of this inventory is fairly stated in the financial statements. Everything is fairly stated. It's absolutely okay. Harshad is saying it should not be any error. Correct? Yeah. But if we remember, we discussed inventory valuation from the perspective of CAM. From the perspective of CAM, would this matter? Do you think will clear the criteria? Okay, will satisfy the criteria of a CAM? Of course, yes. Why? Because this matter involved significant efforts on the part of the auditor. Yeah, so that's why this matter can definitely be a CAM. Okay, yeah, and I think with this you would have got the clarity as to which all matters may become a CAM and may not be an EUM. But at the same time, it is also true that if a matter is EUM, it will definitely be a CAM, but this will not be reported as CAM. And that's why I told you that whenever we look at any matter, first of all, we should check whether they will become modifications, whether they will become EOM or other matters for that instance. Only when they are not falling under any of them, we should take them to CAM. So you can just say that CAM is something which you will look at the last in terms of their evaluation. Clear? Yeah? Nagasai, clear on this? Okay, so now we'll move further on to other matters. On other matters, I'll take you to its understanding once again in the presentation. For other matters, it says if the auditor considers it necessary to communicate a matter other than those that are presented or disclosed in the financial statements, that in the auditor's judgment is relevant to users' understanding of the audit, auditor's responsibility, auditor's report, the auditor shall include other matter paragraph in the auditor's report, provided it's not prohibited by any legal requirement, and when CAM applies, matter has not been determined to be a CAM. Okay, yeah. Then, when the auditor includes other matter paragraph, auditor shall include the paragraph within a separate section with the heading other matter or appropriate heading. So if I go with the requirements in relation to other matters, there are few things which we can note down. It's something which is not presented or disclosed in the financial statements. Number two, in the auditor's judgment, it's relevant to users' understanding of audit, auditors' responsibilities, and audit report. So as per the auditor, now the user's understanding around any of these will increase by including this para. Okay. And its reporting is not prohibited. By law. Law doesn't prohibit. Okay. CAM doesn't cover it. And of course, there is no modification in respect of this matter. Now, what's the first thing which you can make out from other matters paragraph? That if the auditor wants to highlight a matter, but that matter has not been disclosed or presented in the financial statements, unlike the one which we saw in case of EUM, then the auditor will take the route of other matters paragraph, but it's in respect of the matters related to audit and not really the financial statements. Now, the matters are not really related to the accounting. Matters are related to the audit. Correct? And of course, the fact that even though this matter has been highlighted, still it's not getting modified. Okay. Now, in this case, one thing which is very interesting is that because it's not disclosed or presented in the financial statement, so that's why it's getting highlighted. And of course, it's a fact. Why? Because these are all related to the matters of audit. Because you may think, but sir, why these are not getting disclosed in the financial statements? Because management has got nothing to do with this. These are not the accounting matters. These are the matters related to audit. So why should there be a need to necessarily include them in the financial statements? Understood? It's not really necessary. And let's take one example for this. in the financial statements, 2 years are reported, 1819 and 1920. Every financial statement will have 2 periods. This is the reporting year, or which we understand commonly as current year, and this is previous year, or you can say comparative year. CY means comparative year. It's current year over here. Okay. When the financial statements are presented, it will include both of them. And the auditor's report is issued on the financial statements as a whole. Auditor's report will not be issued on a part of the financial statements. Even though auditor specifies in his auditor's report that he has audited the financial statements for the year ended this. Remember, we discussed. Still, if we look at the user, he will understand as if this complete set of financial statement is audited by the auditor who has given the auditor report for 1920. Correct? Now, let's think of a situation wherein previous audit was carried out by auditor 1. So last year, auditor was auditor 1. Last year it was auditor 1 who audited this financial statement. And in the current year, a new auditor has come. New auditor has come. Now, if you look at the financial statements, it would have, or the financial statements would be followed with the report of the new auditor. So it may happen, and it will generally be the understanding of any users of the financial statements that this set of financial statements is audited by who? New auditor, and which is no doubt true also. But last year, was this audited by the new auditor? No. And you may think that, sir, opening balances are required to be audited. There is a separate auditing standard for this. That is again true. But opening balances are audited in the context of their reporting in the current year, not really in the context of doing the audit for the previous year, because that is already audited. In this case, therefore, what can the auditor think of? The auditor can think of including a note in his report through which he will clarify to the users that even though the financial statements which you see have been audited by me, still this last year was not audited by me. This was audited by somebody else. This was audited by another firm. This was audited by another auditor. Okay. And if the auditor will do this, let's try to understand, will it really meet the criteria of other matter? So let's understand this one by one. So it's a kind of checklist. Okay. You can say, which we can tick. Is this matter reported anywhere in the financial statements? No. Because the management need not say that who audited the financial statements. So this is meeting first criteria. Second, do we think that it's important for the users to know in terms of the audit, in terms of their responsibilities of the auditor, in terms of the auditor's report? Of course, yes. So it meets this criteria also. Is there any restriction in the law? No. So this is again meeting the criteria. Number 4, would the CAM cover it? Do you really think it will be a matter of, this will be a key audit matter? Not at all. So this criteria is also covered. And because of this, can the auditor give any modification? No. If all of these criteria are fulfilled, then can we take it as other matter? Of course, yes. Therefore, this will be reported as other matter para in the auditor's report. Okay. Therefore, it will be reported as other matter paragraph in the auditor's report. Clear on this? Yeah. Sorry, the screen was not full that time, but I'm just hoping that you would have understood all of these requirements. Clear? Now, I can take you back to some of the auditor's report that we have discussed. Yeah, the actual audit reports of the companies. Because if you remember, in both the audit reports, there was other matter paragraph. So now we can also look at that other matter paragraph. Okay, so moving back to this auditor's report, if you'll see in the opinion, somewhere they gave the reference of other matters. If you read this para number 2, they gave the reference of other matters. Yeah, I'm just reading it again. In our opinion, and to the best of our information, and according to the explanations given to us, and based on the consideration of reports of other auditors on separate financial statements of joint ventures referred to in other matters section below, the financial statements give true and fair view. So now what we can do is we can move on to the section below wherein this other matter would have been reported. So if I go down, we'll see CAM, which is reported. All these are CAM. All these are again CAM. So they've got a lot of CAMs. Then the other information section. Then I think management responsibilities. Then the auditor's responsibilities have been given. Then after the auditor's responsibilities, what has been reported? Other matter. So let's understand about the other matters as to what is it they have been trying to convey. Consolidated financial statements include group share of net profit so and so and the total comprehensive income for the year ended as considered in the consolidated financial statements in respect of two joint ventures whose financial statements have not been audited by us. So what is the auditor saying? That these two financial statements are not audited by me in the consolidated financial statements. Why? You remember the component audit? These are audited by the components. These financial statements have been audited by other auditors whose reports have been furnished to us by the management, and our opinion on the consolidated financial statements insofar as it relates to the amounts and disclosures included in respect of these joint ventures and our report in terms of the requirements of the Companies Act is based solely on the report of other auditors. So auditor is saying that I have just completely relied on what other auditors have commented in their auditor's report in respect of those two joint ventures. I didn't audit this. Whatever they audited, they reported, I've just taken it and used it for my consolidated financial statement. So I'm just fully placing reliance on the auditor's report of the other auditors. Then at the same time, auditor is saying our opinion on the consolidated financial statements above and our report on other legal and regulatory requirements below is not modified in respect of this matter with respect to our reliance on the work done and the report of the other auditors. So it is clarifying. Yeah. Now let's try to understand about this matter. Is this other matter that two joint ventures have been audited by another auditor required to be reported or disclosed in the financial statements? No. So it meets the criteria. Okay, in fact, I can come to this. Is this required to be disclosed in the financial statements? No. So it meets the criteria. Is this relevant in respect of auditors reporting? Yes. So that's why it meets the criteria. Is this reporting prohibited? No. Do you really think it will become a CAM? No. Is there any modification? No. So what would happen? This would clarify. This would qualify to become a CAM. Sorry, other method. Okay. Clear on the meaning and the understanding about other matters paragraph? All of you? Yeah. Then I can see some queries coming from Sumit and Harshad. Sumit is saying, sir, what's the difference between EOM and other matter? I'm hoping that you are now clear on this. Nagasai is saying, sir, the photocopies are presented by the company due to inspection is done by the registrar. So he's saying the originals are gone to the registrar. So the company has got only photocopies. Then it could be reported in other matter paragraph. Not really. Because it's if the information is not available, if you think the information is not sufficient appropriate, then you will really need to look at the modification. Arshad is saying, sir, please explain prohibition of low point with respect to other matters. See, let's suppose if there is any matter which the law prohibits, that's called as prohibition of law. Arshad is saying, sir, is the CAM also based on auditor's judgment? Of course, yes. As I told you, complete audit report is based on auditor's judgment. And CAM is definitely a part of the auditor's report. This entire audit is based on auditor's judgment. Then Arshad is asking, so the component audit means the audit of subsidiaries or other branches, both. And this is something which we discussed, Arshad. And this is something which we'll again discuss today when we'll pick up consolidation. Okay. Now moving further on to some more requirements related to the reporting requirements. See, we have discussed a lot of requirements in relation to the audit report. And when it comes to those requirements in the auditor's report, we can just say that either the opinion is not modified or the opinion could be modified, wherein we discussed that it could be a qualification or it could be an adverse opinion or it could be a disclaimer of an opinion. Another situation could be about no modification but giving an UM or no modification but giving other methods. So that's why again I'll say these are again falling under this category. This I am also just trying to put in simple terms that this is clean opinion. Okay, so the report is clean. So there's no EM, no other matter, no modification sort of anything. So these are some of the requirements that we have discussed. And of course, in relation to all of them, and irrespective of all of them, CAM is required to be reported. So that's why I'm not really bringing in CAM over here. CAM is separate. So we can say point number 1 is CAM and point number 2 is opinion. Opinion is not impacted by CAM and CAM is not impacted by the opinion. Correct? Now, in relation to all of these points, another thing that we need to remember and apply always will be the discussions with the management and the communications and the documentation. So let's try to understand all of them in relation to all of these matters. Documentation, as we have discussed earlier, covers everything. Yeah. So in respect of any of these type of reportings which may be done by the auditor, documentation is important. So each and every matter which is reported, and whether it's a clean opinion or it's a modified opinion, whether or not any matter has been reported as CAM, its documentation is important. And in terms of the documentation, what is it that the auditor will do? Auditor will have to bring out the planning in his documentation in clear details. Auditor will have to explain the procedures which should be the part of the working papers of the auditor. The conclusions which the auditor would have drawn, that would be again documented. And in terms of the final position which is taken by the auditor to report such matters like these in the auditor's report, auditor would have done discussions. Many a times there could be certain heated arguments with the management. Yeah, there could be a lot of deliberations which may go behind some of these reportings in the financial statements, particularly when it comes to the modification. See, no management would want to accept a modification in their financial statements because this can severely impact the company in terms of its reputation, in terms of certain arrangements which the company may have made, because the bankers may go after the company because the moment they feel that the company is troubled in terms of its financial position, which is reflected through the modifications or say any of these type of reportings, then the borrowings, etc., of the company may get impacted. The stakeholders may start losing confidence, and they may have a lot of questions in respect of these points. The investors may start getting worried. So that's why a lot of discussions will take place before these final positions are taken. And the discussions are not really limited to the client personnel or the management or the CFOs or the CEOs. The discussions will also take place with the audit committee with the board of directors, that means the communications to those charged of governance will also take place. And this is also something which we discussed as part of our discussions of the other auditing standards. And all of these discussions, all of these communications are once again very, very important on the part of the auditor to be documented. So the auditor cannot really just say that he is qualified and he has given them adverse opinions. That's why he can do it with the documentation. Documentation is a must, because whether the auditor is giving a clean opinion or a modified opinion, in both the cases, he needs to have the evidences available for taking such positions. Yeah. So documentation is therefore critical in all of these scenarios. Yeah. And all of these communications and discussions are once again very, very important on the part of the auditor to execute. Clear? Yeah. With this, we come to an end to our discussion on SA 706. Now, as a next step, we need to move on to a couple of auditing standards, which are again in respect of the auditor's report, SA 710 and SA 720. But those are not really the modifications, or these are not really the one which could be in respect of the opinion, etc. These are certain other perspectives around the auditor's report. So we'll pick up these two standards after our break. And we'll also try to look at some more examples. So some of the examples we have discussed and some of the practical examples also we have tried to look at. We'll try to get into some more details around all of these requirements related to the auditor's report. And then we'll also try to pick up something else. So now if you have any questions, queries around all of these aspects of the auditor's report that we have discussed, you can just send across your queries. Okay. And after the break, we can have a discussion on your queries. All right. So we can take a break for 10 minutes now and we'll meet after the break. Hi. So now we'll start with another auditing standard, and that is about auditor's responsibilities in relation to other information. Though we have touched upon this, but we'll now get into more details around this other information which is required to be considered by the auditor in relation to the audit of the financial statements. So let's understand what is this other information and what's the responsibility of the auditor in relation to this other information. Other information may include amounts or other items that are intended to be same as to summarize or to provide greater detail about amounts or other items in the financial statements, and other amounts or other items about which auditor has knowledge in the audit. This may also include other matters. The auditor's responsibilities in relation to the other information apply regardless of whether the other information is obtained by the auditor prior to or after the date of the auditor's report. And talking about this other information, I would say the most important other information is nothing but the annual report, because this would comprise of a lot of other informations, because annual report is one document which contains a lot of information. You remember we talked about it? So it's the same point that we are now continuing on and getting into more details. So it's a document, you can say, or a combination of documents which is prepared typically on an annual basis by the management in accordance with law, regulations, the purpose of which is to provide owners or the similar stakeholders with information on the entity's operations and its financial results and financial position as set out in the financial statements. An annual report contains or accompanies the financial statements and the auditor's report thereon, and usually includes information about entity's developments, its future outlook, risks and uncertainties, statement by entity's governing body, that means the director's report, director's responsibility statement, and the reports covering governance matter, for example, corporate governance disclosure. Okay. So now moving back to this requirement. Say 720. Moving back to this requirement, we are saying that one set of financial statements is there plus audit report. And then there is other information. Other information could comprise of various points. And let's see what all points could be there in the other information. Say it's about the corporate governance, which is covered therein. It's about the board report, which is covered there. Any other financial information. As regards this, we discussed that when it comes to the responsibilities of the auditor is responsible for audit of this. Auditor is not at all responsible for audit of any of this information, or we can say others. Its audit is not the responsibility of the auditor. Okay, but it's definitely the responsibility of the auditor to ensure that if any information, any financial information which is reported in the financial statements, which is there in the financial statements, and which is also included over here under any of these documents, then both of them are consistent. So consistency check. Is definitely the responsibility of the auditor. And similarly, if there is anything which has gone into the auditor's report, maybe in terms of numbers, then again it's consistency check. So I can just change this arrow, save this. Again, it's consistency check with the other information. Is the responsibility of whom? Auditor. Only this part is required to be ensured, and this is not covering audit at all. Okay. Now let's see, in respect of consistency, what all challenges may come and what all requirements are there. Misstatement of other information. Standard says other information may be misstated when the other information is incorrectly stated or otherwise misleading, including because it omits or obscures information necessary for proper understanding of a matter disclosed in other information. Now, what can be this other information? It could be financial or non-financial information, but it has to be other than these two. It has to be other than these two. Yeah. Now let's understand the requirements of the auditor in relation to other information. First of all, auditor should determine which document comprises the annual report and the entity's planned manner and timing and planned manner and timing of issuance of such document. Why? Because during the course of the audit, auditor should also try to look through these documents. And that's why it's important that this other information should also get ready during the course of the audit itself, or maybe before the audit report is issued. Why? Because only then the auditor will be able to go through this. Otherwise, what will happen? It will become a separate task, because during the course of audit, he is reviewing everything. He is there on the field most of the time. So he'll also be able to look through all of this information. So that's why, what's the management plan to prepare these documents? Okay, and when the management plans to issue all of these documents is something which the auditor will have to determine, so that he can plan his work in terms of ensuring that they remain consistent. Okay. Now, in respect of all of these documents which the management would provide, it may happen that these documents go through various cuts, go through various versions. Because when it comes to the final version, a lot of discussions would take place and lots of changes will take place, because the management will look at various perspectives of the investors, views of various stakeholders, and depending on the numbers which will be getting finalized, all of these languages, etc., will change. So some of the financial data may be included, then it may get deleted. The management may want to come up with different type of analysis, or maybe the moment data changes, the analysis also get changed. That's why even though the auditor may get this information, the final version, which is actually going to be reported by the management is the most important part, because the auditor needs to ensure that the final version is there with him, with which he can do the consistency check. And that's why it's not only limited to doing a first time check, it's also about doing the final check. And if there happens to be anything in terms of inconsistency in relation to any of these documents, now then what's the duty of the auditor? To ensure that it gets corrected in the financial statements or the other information. Okay. Now, during the course of audit itself, auditor may find something which he may believe that it is most likely going to form part of the other information. Because most of these annual reports, most of these documents which form part of annual report, they also have got certain standard criteria which auditor knows will be flowing over there. So auditor should be wary of the fact that this much part of the information will definitely form part of this other information. And even if that is not available to him till the time his audit is concluded, still he should remember and make sure that this much part he will be requiring to check later on. Now let's suppose there is an inconsistency which is material, or the other information appears to be materially misstated. So what would the auditor do? If the auditor identifies material inconsistency, he shall discuss the matter with the management, and if necessary, what would he do? Either he will get it corrected in the other information, or he will get it corrected in the financial statements. Because it may happen that during the course of his procedures, the financial statements, the way those have been laid out in terms of the numbers, etc., continued to have a misstatement, and which didn't come to the notice of the auditor, even though it was correctly recorded in the other information. And it was not intentional. It could be an arithmetical mistake which has been continuing, and it's been missed by the management as well as the auditor. But now, because consistency check has been done, at one place it was reported correctly, other place it's not reported correctly. So it's not necessary that auditor will only get this one corrected. Auditor may have to get this one corrected in line. So either of these will have to be corrected. So auditor will have to look through both these documents, and therefore auditor will have to do a fair analysis as to which information is correct in case there is inconsistency. So auditor cannot just say that the financial statement will always be correct. This assessment will have to be done by the auditor, that out of these two documents, which document is giving the right information, and for which auditor may plan to do additional procedures. Auditor may get into some more reports. Auditor may get into some more requirements in relation to his audit. So he may require certain more reports from the management in respect of all of these data which is inconsistent. Okay. Now, if the auditor concludes that there is a material misstatement of the other information, so first step is about discussion with the management, and the management agrees. So if the management agrees to make the correction, what would the auditor do? Auditor shall determine that the correction has been made. Means he'll have to check it again, that of course, yeah, it's rectified, it's corrected, and it's good to go. Sometimes the management may not really agree with the auditor. Management may say, no, we will keep the document in respect of other information with the same number with which it is finalized. Even if there is inconsistency, management may say that financial statements is what you are auditing on. So that is not materially misstated, and you should go with that and you should ignore the other information. In such a situation, what would the auditor do? In such a situation, auditor would communicate with those charged with governance. He would report this matter further now to audit committee that this is a material inconsistency which has been continuing and the management is not getting this corrected. So we need this correction in the other information. Okay. If the auditor concludes that a material misstatement exists in the other information obtained prior to the auditor's report and the other information is not corrected after communicating with those charged with governance, so in such a case, what would the auditor do? One, he will consider the implications for reporting in the auditor's report and communicating with those charged with governance about how he is planning to address the matter in the auditor's reports. Then he'll see whether any reporting is required in his report. And of course, if that is required, once again, he'll communicate to those charged with governance that I am going to report this matter in my auditor's report. In certain cases, which is very, very rare, he may plan to withdraw from the engagement, wherein the matter is very, very serious in nature. And again, that is not really preferred, but this is one area which will have to be analyzed by the auditor. At times, auditor may find a material misstatement in the other information, but that is after the date of the auditor's report. So the auditor's report is signed off and now the auditor is finding those material inconsistencies, or you can say these material misstatements in the other information. In such a case, what would the auditor do? In such a case, once again, there are two situations. Maybe the other information is now corrected. Then the auditor will perform procedures to check whether those are corrected or not, even though the auditor's report is gone out still, because it's not issued outside the company. So auditor will have to ensure its consistency and ensure that it's corrected now. But if this other information is not corrected and the auditor has also communicated with those charged with governance, they are also refusing to correct it. Auditor has also issued his auditor's report. So then what would the auditor do? He would consider taking appropriate action considering the legal rights and obligations that will have to seek to have uncorrected material misstatement appropriately brought to the attention of users for whom the auditor's report is prepared. Now in this case, because the auditor's report is finalized, he has already issued it, so he'll have to evaluate how he will bring it to the knowledge, to the users, to the attention of the users, that there is a material misstatement which is uncorrected and that has been continuing, and for some reason he could not report that in his auditor's report because it came to his knowledge after issuing the final audit report. Okay, clear? Now, if as a result of performing the procedures in relation to this other information, auditor concludes that a material misstatement in the financial statements exists, or auditor's understanding of the entity and the environment needs to be updated, so the auditor will definitely get into certain more procedures. Now let's look at the reporting requirements. In relation to the reporting requirement, as we have seen, there will be a separate section. There will be a separate heading by the name of other information on which auditor is required to specifically report. In respect of other information which is flowing into the auditor's report, What is it that the auditor would cover? A statement that management is responsible for other information, an identification of other information. For example, he will say that this other information includes annual report, etc. And for an audit of financial statements of listed entity, other information, if any, which is expected to be obtained after the date of the auditor's report. So that information also he will specify if that is the case. A statement that the auditor's opinion does not cover other information means he is not auditing the other's information. He is only doing the consistency check. So that means a description of his responsibility is related to reading, considering, and reporting on other information. And when the other information has been obtained prior to the auditor's report, a statement that the auditor has nothing to report on that. And if the auditor has concluded that there is an uncorrected material misstatement, statement that describes the uncorrected material misstatement. Okay. Yeah. So now what we will do is, now we will get into that audit report once again, and we'll just try to understand all of those perspectives in the light of these requirements. So I'll just take you to that audit report once again. So we had this report. Just 1 minute. Okay. Information other than financial statements and auditor's report thereon. So let's read these requirements once again, though we have briefly touched upon this, but let's read this once again in the light of all of these requirements that we have studied. The company's board of directors is responsible for the preparation of other information. So it's similar to the financial statements which the auditor is doing. So now on this other information also, auditor is saying that this other information is the responsibility of the company and not mine. This information included management discussion and analysis, board's report, including annexures to the board's report, business responsibility report, corporate governance and integrated report, but does not include consolidated financial statements and our report thereon. Means all of these are specified. So he's saying who is responsible for this, what all information is the one which he is looking at or which he has looked at. Then he's talking about his opinion. He's then saying our opinion on the financial statements does not cover other information, and we do not express any form of assurance conclusion thereon. Okay, so there's no assurance, there's no attestation that he has done. Now he will also say, he will also clarify, he will mention what all he has done. In connection with our audit of the consolidated financial statements, our responsibility is to read the other information, compare with the financial statements of the joint ventures audited by other auditors to the extent it relates to these entities, and in doing so, place reliance on the work of other auditors and consider whether other information is materially inconsistent with consolidated financial statements or otherwise appears to be materially misstated. Other information, so far as it relates to the joint ventures, is traced from their financial statements audited by the other auditors. Because this is about consolidated financial statements, so he is clarifying on all. consolidated financial statements of the joint ventures, everything compared with all of this other information. Then he is also specifying if based on the work we have performed, we conclude that there is a material misstatement of this other information. This means all of this other information. We are required to report that fact. Okay, so once again, what has he done? First of all, he has brought out his responsibility. So he's saying if there will be any material misstatement, if there is any material inconsistency, then our responsibility is to report. Then he is also saying that is there anything for him to report or not? So it's okay to know about the responsibility, but whether he has performed his work, whether he has been able to conclude this. So he's saying yes, we have nothing to report in this regard. Okay, so he's saying we have nothing to report in this regard. So it's all done, it's all covered. So there's nothing on which he needs to report on. So it is also concluded. Clear? Yeah. Now, if there will be any material inconsistency which continues, so what will he do? He will bring it out over here. He will bring it out in this section, provided the financial statements are not materially misstated. So let's try to understand this. If the financial statements are completely okay, other information is misstated, then where will he report? In this section. Reporting will be in this section. But for some reason, when he compares this information and finds that information to be inconsistent and which continues to remain inconsistent, then the management and the auditor cannot say that this other information will always be considered to be incorrect. No. On the basis of the procedures which the auditor will perform, he will have to assess out of these two which one is wrong. If he concludes that the financial statements are not correct, or the information in the financial statement is not correct, then he will have to report on the financial statements, and for which all of those essays that we have discussed, he will have to apply. Then he will not just simply say that other information is inconsistent. No, because now the other information is absolutely fine. Please try to understand. Now the board report, which contains, say, the revenue number, is reporting that number to be okay, but that number is not appearing correctly over here. So that's why in this case, what will be the responsibility of the auditor? That's why in this case, the responsibility will be of the auditor either to correct it, either to get it corrected, or if this is not corrected, apply essay 705, 706, which we discussed. Whatever is the relevant one. Okay, clear on this? In this scenario, auditor cannot just take the plea of 720 and conclude this matter. No, that will not work over here. Clear? Clear on this part? Now, this area has been gaining a lot of importance over the period. See, a very simple assessment which anybody will do is about consistency check, because at times it may be embarrassing. Companies spend a lot of efforts and lot of money in respect of the financial report. So there's a big team of the company which will be doing the accounting work. There's a team of the company that will also be involved in financial analysis. Then money is also spent on the audits throughout the year. And let's think about the large companies for which audit continues throughout the year, in fact. Yeah. Significant effort, significant cost is involved in this. And for such companies, when the intent of the management and the auditor is correct, and there's no intent to keep anything which is inconsistent or say to have any material misstatement in the financial statements. Let's suppose there's some other information wherein profits are reported. Let's suppose profits are reported as 190 crore. Okay. And the discussion around the profits uses this number 190 crore. Okay. But in the financial statements, let's suppose the profit is 109 crore. Okay. Now let's think about the investors. For these companies, investors are very, very important. Stakeholders are very, very important. Now, this mistake is only unintentional. This could be as simple as clerical mistake or maybe a typing mistake. Maybe everything was okay, but when the annual report went into the printing, so there was some printing mistake. It could also happen over there, isn't it? But let's understand the consequences. The investors who will be going through this document will find this document to be not reliable because they will get confused. Yeah. And this can become a very, very embarrassing situation for the company, for the company's management. Yeah. So that's why a lot of efforts go behind this. So this is one reason because of which this area is important. Plus, another reason for this area to be important is because of the fact that these days, when the companies have been growing, when the companies have been expanding, companies have been going on for funding outside India, or investors have been coming in India, and they have been putting a lot of money into a lot of companies which are large size, medium size. For all of those investors, for all of those stakeholders, this other information is very critical. Needless to say that this financial statement is also important, but many of their assessments are based on other information which is provided by the management. And that's why it should be important that whatever goes into this other information is something which is true and in line with the financial position of the company. And that's why this area has been gaining importance. And that's why this requirement also came into place. If you go back a few years, this requirement was not there in the auditor's report. This got added. And the addition is due to the fact that this area has now become important. Okay, clear? And I understand that this area is also important from the examination perspective for all of you. So you should take adequate care accordingly. Clear? Now, coming towards the end of this auditing standard, in respect of all of these procedures, which is performed by the auditor, documentation once again is very important. Because to document what all procedures auditor would have planned, what all things auditor would have looked at in terms of the other information, and how this consistency has been ensured by the auditor is again important on its part, and that's why documentation is again very, very important area over here. Okay, clear on this? So if you have any questions around this, please let me know. I missed one query of Sumit. So Sumit is asking, So what is the order to report? First, it should be in CAM, then it should be in EOM, and then the other matter paragraph. According to the significance, matter should be reported. No, so first of all, in terms of these three which you specified, whenever there's a CAM is something which comes, whenever there's EOM, it's something which comes first immediately after the opinion. Okay, and then of course the CAM. Other matter is generally you will find towards the end of the report. It will not come at the beginning. Okay, that's the order. EOM, CAM, other matter in respect of three items which you asked me. Now we can move on to next auditing standard, which is again around the report SA 710. Any more questions from your side? Okay, so moving on to the next auditing standard, 710. 710 is about the comparative information. And around this comparative information, I would say to a certain extent, we have had some discussions, but still around some of these things, it will be good to have some more perspectives, and then we'll look into some examples also around all of these reporting requirements. Let's understand the meaning of comparative information, corresponding figures, which are reported in the financial statements. So what is comparative information? Amounts and disclosures included in the financial statements in respect of one or more prior periods in accordance with applicable financial reporting framework. So it's about the previous year figures which are reported over there. So in the financial year ended 31st March 20, the numbers that we report for 31st March 19, for the year ended 31st March 19, that is what? That is all comparative information. That is all previous periods information or previous years information. Moving on to the next item, that is about corresponding figures. It's also the comparative information where amounts and disclosures for the prior period are included as an integral part of the current period financial statements and are intended to be read only in relation to the amounts and other disclosures related to the current period, referred to as current period figures. The level of detail presented in the corresponding amounts and disclosures is dictated primarily by its relevance to the current period figures. So I would just take one very simple example to understand around the corresponding figures. In respect of the listed companies, every quarter reporting is required to be done in terms of their information about profits or the profitability or the P&L, etc. And all of these reportings which are required to be done in respect of the P&L, etc. The reporting is required not only for the current period, but also for the corresponding period. For example, say for the quarter ended 30th June 2020, P&L information has been presented. Okay. P&L information has been presented. Now, corresponding to this, the information of the P&L for the quarter ended 30th June 2019 will also be present. Yeah. Now, in this case, what are we trying to do? We are not reporting the immediate previous quarter. We are reporting the immediate corresponding quarter. Okay, which should become comparative. This is something which we can understand as corresponding figures. Okay. Now moving further on to comparative financial statements. Comparative information where amounts and other disclosures for the prior period are included for comparison with the financial statements of the current period, but if audited are referred to in auditor's opinion. The level of the information included in those comparative financial statements is comparable with that of financial statements of the current period. So let's understand what do we mean by this. If you look at the financial statements of 2021, this will always include 2019, 20. Now, if we look at the financial statements, what do we call it as? Financial statements for financial year 2021. So whenever you will have to understand, you will acknowledge it. You will always acknowledge it, saying that these are the financial statements for year ending 31st March 2021. You will never call these financial statements to be the one of 1920. No. These are the financial statements of 2021. But comparatives are always an integral part of these financial statements. These comparatives are integral. We cannot just simply say that these comparatives can be ignored. Is it possible? No. As per the accounting standards, it is not possible. So when they form integral part, without which financial statements are not completed. So in a way, we can say that the auditor has not only audited this, but the auditor has also covered this in terms of his audit opinion. And that's why when the auditor would give his opinion, what would he do? He would also clarify that even though I have audited this, and which comprises of this, its audit was done by some other auditor in the previous year. In the current year, I have been keeping this as my comparative audit, or I have performed procedures on this year considering that to be a comparative only. Correct? Yeah, so that's the perspective he'll take. Yeah, clear? Now the question arises as to what all procedures will be performed by the auditor in respect of this corresponding or comparative information. So let's try to understand some of those requirements. First procedure, and which is a very basic procedure which any auditor would do, will be to ensure that all these comparative numbers are traced to last year's financial statements. Last year means currently we are in 2021. Last year financial statements of 1920 would have been prepared. Correct? When the numbers of 1920 would have been prepared, those would have got reported, and same numbers would now be carried forward by the management. Management would have picked up all of these numbers of 1920 from where? From last year's financial statements. So that's why, as a first step, what would the auditor do? Trace all of these numbers, all of these information to the audited set of financial statements of 1920. Correct? Next, accounting policies which are reflected in the comparative information, those should be consistent. Now, last year, when the audit was performed, or when the financial statements would have been prepared, so I'll just bring in one more column over here for the purposes of our understanding. This is again 2019-20, and for your purposes, I'll just take you to the board now. See, this is financial statements, and that's why current year. This is comparative year. In fact, instead of current year, I'll call it as reporting year. Okay. This is the reporting year. 1920 would have been the reporting year in the last year. So last year this was the reporting year. Okay. Wherein some of the information would have been reported. So first step is what? Tracing all the numbers. Tracing the information. That's the first step. Tracing the information. Number two is what? Number two is to ensure that all the accounting policies, etc., all the accounting policies, etc., which were used or which were applied for the preparation of the financial statements of the last year 1920, those have been carried forward to this year. Okay. To this year. So this is about consistency of accounting policies. Why is this consistency important? Whenever any change in accounting policy will happen, those changes are once again required to be in line with the requirements of the auditing standards. In case the accounting policies are changed and which are not really in line with the requirements of the accounting standards, then certain disclosures are required to be made in the current year. In case accounting policies have been changed and which are in line with the requirements of the accounting standards, even then some disclosures are required to be made. So how will that be known to the auditor? Only when this comparison is done, only when this consistency is checked, to ensure that all disclosures which were required as per the criteria which are prescribed have been covered over. To ensure appropriate disclosures are given. Okay, yeah. Next aspect is about the audit of the last year. Now, when the auditor will be auditing the information of the current year, what would he do? He would no doubt issue an opinion on the financial statements, which includes this year. Still, as per the requirements of other essay which we discussed, what would he do? He would bring out other matter paragraph. He would bring out other matter paragraph to clarify to the users of the financial statements that the other information which has been audited, the comparative information which has been included in the financial statements was audited by some other auditor. Okay, though it's rare, but in case, though it's rare, yeah, you will not see this happening. In case there happens to be some information of the comparative area which is not really audited, say for any reason, this aspect will also be covered by the auditor. Though in our situation it's not possible. Okay. Now this would apply to all of them. Now these understandings that we have obtained in respect of the auditor's report in terms of the reporting in the other matter, whether it is about comparative information or it is about corresponding information, it will apply to both of them. In both the cases, auditor will be reporting in the other matters paragraph report. So that's why in case of the listed companies for whom quarterly audit is not done, for whom quarterly review is done by the auditors, therein in their review report, you get to see one other reports para. There is para which is talking about other matters. Okay, clear? And in respect of all of these points, once again, one of the areas which happens to be important is what? That is about documentation. So each and everything in respect of all of these areas are required to be documented appropriately by the auditor, because if the documentation is not there, then of course whatever evidence he would have obtained, that would not be considered to be the evidence or the evidence which is sufficient and appropriate. Clear? Yeah. Written representations are all required to be covered over here. And in terms of the written representations would also include all of these matters which will go into the reporting requirements. And now we are basically talking about all the reporting requirements. This is not really limited to this essay. So what we'll do now is we will pick up few examples to discuss some of the reporting implications. And we'll just try to capture all of the areas that we have looked at, or maybe any of the areas that we have looked at so far. So I will not really remain limited to any particular auditing standard now. Okay. So I would say it's about audit report now. I think we have spent good enough time on all of these auditing standards related to the audit report. So that's why all of you should try to answer all of these questions. Even if though they go wrong, it doesn't matter, but just try to think about it as to how would we really deal with those matters in the auditor's report. Correct? Let's suppose this is a company PQR Private Limited. Company which is quite large. If you look at the revenue, say it will be somewhere around 5,500 crore on an annual basis. But the profitability is not very good. Though the top line is very good, but the profitability is not very strong. So it has profits of around 10 to 15 crore per annum. Okay, so that's the profitability. But the company does have profits. Yeah. Now, during the course of the audit for the current year, auditor observed few matters. First, revenue recognition was a big problem for the auditor because the company entered into certain new transactions, and considering the top line of the company, the transactions were also significant, and the transactions involved complex accounting requirements. Accounting requirements were complex. Okay, auditor considered this area to be significant risk. In the past years, this was also considered as fraud risk area. And in the last 8 to 10 years, what the auditor get to know is that there has also been a fraud in the company in relation to revenue recognition around 8 to 10 years back. Okay. Now, in relation to this first matter, in the current year, there is no material misstatement. No material misstatement in current year. Correct? Yeah. So first matter is understood. Moving on to matter number 2. There were certain disclosures around financial instruments. Financial instruments. Which have not been given. Auditor assessed this, and the discussion also took place with the management. But the management is not ready to give those disclosures in their financial statements. And this is not because of the fact that management doesn't intend to give. No, their intent is all right. It's just that there's a difference of opinion. So management doesn't want to hide anything. It's just that because of difference of opinion, whatever management understands on the basis of that, they don't think such disclosures are required to be given in the financial statements. But the auditor is very sure, and the auditor believes that these disclosures are very important for the understanding of the users of the financial statements. Okay. These are fundamental to users' understanding. If not given, this may impact the decision making of the users. Two matters. Correct? Another matter. Matter number 3 was formed. In respect of certain expenses, miscellaneous expenses, and in respect of certain computations around depreciation, many mistakes were found. Many mistakes were found. It was not one. Many mistakes. You can say easily running into 30 to 40 mistakes. 40 mistakes were found. Impact, if we take for all the mistakes, is not very significant. It's not crossing the materiality. But the auditor got so uncomfortable, auditors got so pissed off that he's not happy, he's not comfortable with these two areas at all. And that's why auditor is of the clear view that these two areas will have to be qualified in the financial statements. Yeah, the way the management handled this area was not at all appreciated by the auditor. Auditor was very, very unhappy in respect of the financial statements with regard to these two areas. Okay, and he is very clear in terms of his thought that he will qualify these two items in the financial statements. Management has been requesting the auditor not to qualify this. Why? Because management is saying that these are all arithmetical mistakes, or maybe whatever was the nature of the mistakes, all these mistakes have been accepted by the management. The only thing is, management is saying this is not significant, so why to get into its correction? And this is something which is not liked by the auditor, and that's the reason of the qualification also. At one place, auditor is finding so many mistakes, and which have also been accumulated. Then the management is not ready to correct them. Why? Management is saying, let's ignore it, we'll pass it later on or in the next year. Why? Because the time is running out, we need to close the financial statements, and let's move ahead with this. But the auditor is not liking it. Auditor is saying, I'll qualify. Okay. So we can see these three situations in the audit of the financial statements. Fine. I'm just hoping that you have understood all of these things. So now we need to understand how all of these areas will be handled by the auditor in terms of his audit report. Okay. Yeah. So I'll need some space. Option number A. Matter number 1 is clearly a can. Matter number 2 is clearly not a modification, qualification. In fact, this is fundamental. Oh, this should be adverse. Matter number 3 is a qualification. Okay, this is option number 1. Option number B, 1 is no doubt a CAM. Matter number 2 is fundamental. So, fundamental is something which should be given as EUM. Third is not really a qualification. Should be ignored. No reporting. Okay. Option number C. Now for option number C, I'll need some more space, so I'll clear this point. Option number C says 1 should not be a CAM. Instead, it's better to give a qualification on that because it's matter related to revenue and this should always be taken care of and it involved complexity, etc. So it's better to give a qualification. Option number 2, I think EUM fits this. And option number 3, for these expenses, etc. And these are not really crossing the threshold. So let's keep it as EUM or CAM. It can go to either of them. Option number D. Option number D says for 1, let's not report it. No reporting. For area number 2, qualification. For 3, no reporting. Okay, so we have got these four options, and it now comes down to you. You need to evaluate all of them one by one. And this covers significantly a lot of things that we have discussed in terms of various reporting requirements. So quickly, if you can just start sharing your responses, we can also have a discussion around it. Just give me 1 minute. Quickly. So then we'll get on to the discussion related to all of them one by one now. Okay, I can see a couple of responses coming in between. That's good. You can also keep sharing the responses. Preeti and Nagasai are saying it should be option number B. So 2 responses. Anyways, I'll get from the solution now. So looking at first point, revenue recognition, complex accounting, significant risk, fraud risk, significant efforts of the auditors, etc. have all got involved. There's no doubt it will meet the criteria of a CAM, but if we understand it's a private company to which CAM doesn't apply. Yeah. So automatically this option goes away. And this option number B also goes away. Yeah. So these 2 are automatically gone out with this. Moving on to option number C. Option number C. It says there should be a qualification, which is possible. No. Why? Because there is no modification. Because there is no material misstatement. So how can the qualification be given for point number 1? For point number 2, it's a disclosure misstatement. But this misstatement is material. At the same time, it's not pervasive to the financial statements. So can this really be limited to EUM? It's of course fundamental to the understanding of the users of the financial statements, but there is no doubt that it's a material misstatement. So if this is a material misstatement and which is not pervasive, what should we do? We should not be limiting ourselves as an auditor to an EUM. So that's why this option also goes away. Third, in respect of these two matters, will they really qualify to be a CAM? I don't think so. And can they become EUM? No. Because are they so fundamental for the users to know that the management made some mistakes which are below materiality? Which could be numerous mistakes. But let's think about a company which is a large size. 30 to 40 mistakes is again acceptable. So can this be the option therefore? No. This once again cannot be the option. I see one response coming from Harshad. I'll just quickly read out. He is saying for complex accounting requirements, we can use the work of other auditors. For significant risk, we can report the EUM. For difference in opinion, we can refer those charged with governance. In respect of certain expenses and depreciation, we can draw attention of the management to correct the same. Yeah, so he just given one the way it's required to be handled, but I think he has not really given the option out of these which one is required to be selected, which is again fine. Now moving further on to this option number D. Now for point number 1, of course, no reporting is possible. So that's why it appears to be okay. Point number 2, we can say it's a qualification provided the impact is not pervasive. So we are assuming the impact is not pervasive. So that's why it has to be qualification. Third, because these areas were having a lot of mistakes, but at the same time considering the fact that all of these mistakes on an accumulated basis did not cross the materiality, can there be any qualification reporting? No. But yes, for sure, in respect of these two, for the uncorrected mistake steps, which the management doesn't want to pass, auditor cannot take it on himself that I'll qualify. No. Auditor can ask the management to put all of these uncorrected misstatements in the written representation letter, and which the management will do. Correct? So that's why for this one also, what should be the right option? Option number D. All right. Yeah. Clear on all of these points? I would suggest that you should also practice similar type of questions with which you will find application of all of these requirements that we have discussed so far. All right. Yeah. So with this, we come to an end to our discussion today, but unfortunately, we could not pick up this consolidated financial statements. As around that consolidated financial statements, which we plan to start in the next session, and of course, the planned topic of the next session will also be covered therein. Majority part of it is already covered by us. When we did SA 600, we did majority part of this standard, but there are a few more elements around this topic that we plan to cover in the next session. Okay, so we'll start with that topic in the next session, and then we'll move on to the next topic. Yeah. So with this, we end our discussion over here, and thanks to all of you once again for your time and for your wonderful participation. Thanks so much.